Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly review for the week ending February 2nd, 2024. Looking at the markets this week. Very positive week on bonds. As we're entering the year, markets were expecting lots of rate cuts in 2024, earlier in the US than in Canada. Now, we had the Bank of Canada last week coming out with its statement. This week, it's the Federal Reserve, which is hinting that, rate cuts will happen in 2024, but not so soon. More on that in a minute. But markets are digesting all of this. Economic data in the US continues to surprise positively. So, the volatility this week was positive for bonds, 4.4% for the long index, still negative year to date, but we just wiped out most of the negative performance on the year. Equities, this is a big week of earnings for the tech sector in the US, some good, some not so good. Overall, the market is taking it in stride. Nasdaq is down a little bit on the week. S&P 500 is up. As we're looking ahead this year, likely what happens with big tech will be important on the earnings front, but also on the sentiment front. Could we see, exuberance, and could we see a mania? These are all questions that we're asking. So right now we have a neutral view on equities because there's positives and negatives when you look at valuations, expectations for earnings. I'll discuss that in a few minutes. I think it's good to just to surf the wave right now. But an interesting start to the year. But we did end January in positive territory. Mentioned that a few weeks ago. It tends to be an indicator, so bodes well for the year. But we still expect volatility to be a hallmark of the H1 this year. Price of oil lower on the week by 5%. USD weaker, so CAD, Euro higher. Price of gold higher also on the week. Very interesting market environment. Now the Fed had their decision this week. Mr. Powell was pretty clear on a few fronts. Rate cuts are coming, but not so soon. That's the message. And Mr. Powell even took out a sheet of paper to answer a question about rate cuts in March, to say that, conditions, it's unlikely that conditions will be there for a cut in March, pretty much closing the door. So now the markets are repricing the path for 2024. And that brings us to what's priced in here. And this is updated as of this morning following the jobs report. Jobs report was much hotter than expected. And as you can see on the chart here, you have March, June, September, and December. How many cuts are expected for each meeting? Now we're converging towards zero for March. The market is pricing that out. But as you can see, market was expecting still about 6 cuts for December. So markets were starting to price, all right, maybe it's going to be later, but maybe faster than expected for rate cuts. Now, the later part, we think it's right that the market sees that. This is our expectations too. The faster part, the U.S. economy, unless we have, a sharp turnaround, looking at the strength that it has right now, we should expect the Fed to start going somewhere around mid-year, but that may be cut somewhere around 3 times. This is still our base case scenario. And the market this morning, following the jobs report, as you see on the right, pretty much depriced almost 1 hike by the end of the year. So it's still very sensitive to that, and it brings volatility into the markets. And looking at the labor market here, 350,000 jobs created in January, way above expectations. So we see that it's either a soft landing or a reacceleration of the US economy. So it's a very interesting environment. The wage growth on the right, we like to use the Atlanta Fed measure because it corrects for the composition of the labor market. We see that wage growth is still about 5%, so it's still likely too hot for the Fed to be confident that inflation is getting back steadily to 2%. So they will start cutting at some point, but they might not be in a rush. And when you look at the economic data here this week, we have the ISM manufacturing index, which is rebounding. It's good news. The leading indicator, which is the new orders less inventories component, the red line on the left chart, is pointing towards more acceleration. So good news here. On the right, kind of, the caveat is that the breadth remains weak. So the number of businesses or sectors that are reporting growth remains very weak. So right now it's not a strong foundation, but let's see if it picks up with time. There's that caveat. But if you go to what's priced into the markets, because of course, when you look at the economy, you should expect earnings growth to follow, economic growth. And this is what you have on the left, year-over-year growth in earnings versus the ISM manufacturing. So ISM manufacturing is looking to pick up. It's unlikely that it will pick up enough to give credence to the view that's expressed on the right. This is from Bloomberg. These are the expectations of analysts looking at Wall Street. So if you look at what's expected for the next 12 months for earnings versus what we saw over the last 12 months, and you just divide the two, you see you get the green part on the bottom right, that markets are expecting, or rather analysts are expecting earnings to grow by 10% in 2024. So this is not really realistic with the view that we have on the macro side. Even though the economy could reaccelerate, likely it won't reaccelerate enough for that. So of course, this is a moving target. Let's see how the data evolves over the next few months. But right now, we see that the S&P 500 is expensive on a PE basis, and earnings expectations are aggressive. So both of these arguments would generally, lead us to have a negative view on equities, but the sentiment and the momentum that we have remain quite strong. So thus, right now, the neutral view on equities. So for Canada, what to watch next week? Building permits, net change in employment, and unemployment rate. We should have strong job creation, 15,000. Unemployment rate should still go up a little bit because we're not creating enough jobs for the growth in population. So that continues, or that is expected to continue. In the US, ISM services, senior loan officer survey, very important component of the business cycle, what goes on with credit and the consumer credit figures. So that wraps it up for this week. ia.ca/economy for the review of the podcast, iagam.ca/insights for the monthly and for a few weekly pieces from my colleagues. Lots of material for everyone. Always a pleasure to serve you, and I'll be back again next week.